Okay, let's officially begin. Welcome to the Foundation Study of Cycles Financial Cycles Summit. This is day 2. Big welcome to all of the attendees that continued with us into a multi-day event. This is an extended version. And just a reminder that this is a big record attendance from the last one early this year. We look forward to building that momentum out into the future. Today's speakers, it's 2 speakers per day, but then today's is unique in that we have a fireside interview between our FSC board member, Bradley Rotter, in conversation with Chairman Dr. Richard Smith, speaking about crypto, quantum computing, and where do we go from here. There's disruption opportunities here and now that we should really be discussing as part of that scenario planning for the future. That will be followed by FSC board member Jake Bernstein, who will be talking about interest rates, currency, long-term cycles, and more. You heard him yesterday talk about palladium, the Japanese yen, and I think I've missed another market that he shared with us as a special feature, but stay on for that. It'll be an exciting session to follow up with. And of course, Q&A to follow both segments. Day 3, just as a heads up preview, and I'll repeat this at the end of our session just as a reminder, we have our guest speaker, Peter Eliadis, who'll be talking about her cycle theories, projecting future prices and the current US market. And that will then follow with FSC board member Bill Cerubi on US stocks, real estate, and the economy. And just to remind that some of our board members are discussing the same market themes as a ongoing update, but of course, they will be featuring latest insights in this fast-moving market. Remember the benefits to membership. It's active webinars and content development in general, webinars on the TV, of course, community, which is a big part of these professional organizations, connecting with each other and learning about a common mission and passion in terms of cycles. The fellowship with like-minded professionals, and then finally the Cycles app, which allows you to turn the framework into a real-time strategy and way of monitoring both markets and other data sets. And then most importantly, as a nonprofit organization, I always like to remind that your help really does go the extra mile for all that we do here and in the near future. There are different ways to support us. So traditionally, monetary donations, but then also continued support towards raising awareness. Speak to your friends, especially those that can support us and raise awareness. And then, of course, contribution of ideas, time, and just being part of the community is everything. I've received a few emails already from day 1 about people that would like to do that. I think it's great. Please express that interest in the chat or an email. We'd love to hear from you. Visit our website for more information about the Cycles activities, but also for donations. The link will be shared in later on today. And then a reminder, please send questions in Zoom Q&A box throughout the session. I will collate them and then save them for when we get the opportunity to follow up. So please warm up ahead of time just so we can make sure that your questions get answered. And just as a warm up to using that chat function and just keeping it engaging and interactive, if I can ask you all to share in the chat what your insights were from day 1 of our Financial Cycles Summit. Remember, the 2 presentations were Cycles, Correlation, and Volatility by Dr. Richard Smith and Roadmap Cycle Insights by myself. So what were the top insights that you took away from either or both of those sessions? Type in the chat. It'd be wonderful to know what was high impact, meaningful to each of you. Okay, and as we prep for the main session, I'll just take a selection of feedback here. Hope is saying buy Swiss dollar. Sergey saying you guys, yeah, please can you enable the chat? Any other feedback on that? I can follow up on, but buy Swiss dollar was, I think, one that was remembered. And I'm sure there was a lot more that will be shared in a moment. Importance of wealth preservation, that was something that I think both Richard and I emphasized. And I'll let the chat continue in a dynamic way. Okay, so to stay on time, big introduction to our feature fireside interview with FSC board member Bradley Rodder in conversation with Dr. Richard Smith, crypto, quantum computing, and where do we go from here? Bradley Rodder is an investor in technologies that impact the security of the homeland. He was a pioneer of the financial futures when trading on the floor of the Chicago Board of Trade and the Chicago Mercantile Exchange. With an extensive background in cybersecurity, Rodder was drawn to cryptocurrency and has been a leader in that space for 8 years as an investor and international speaker. After graduating from West Point, Rodder got his MBA from the University of Chicago. Bradley, Richard, over to you.
Hey, Richard. Ron, and thanks everybody for joining us again. And Brad, it's great to be with you.
Good to see you.
Looking forward to having a good conversation today. And, you know, every time I talk to you, I feel kind of like I'm talking to the Forrest Gump of finance. Am I the first one to make that analogy with you in financial history?
Yes, you are. And the last, hopefully.
And the last, hopefully. Right. Exactly. Sorry about that. But I'm excited to really delve into all the financial history that you have, you know, had a front row seat to, because I think there's so many new people in the markets today, right? There's so much new interest in the markets today. And yet, there's a lot of inexperience. And you've seen multiple cycles of financial innovation and led many of the cycles of financial innovation. So I'd really love to just kind of get into the history of it with you, your history, and kind of, you know, take us through the past, you know, few decades of what's been going on in finance, and then we'll get to today and what's going on today. And so to kick us off, I have this, one of my favorite books, The Complete Turtle Trader, here by Michael Cavell. And you're in the index like half a dozen times in this book. You were one of Richard Dennis's first customers or first investors.
I was his first investor, actually, when he started managing money.
And then one of the original turtles was your former employee.
Yes, the Turtles was an interesting project. Maybe it might be best just to step back a few years before that.
Absolutely. Yep.
And I'll tell you how I sort of got interested in the markets. I grew up on a farm in Iowa, which is a small state in the Midwest. And
I think I've heard of it.
I was in charge of hedging our one corn contract for our family farm. So I was trading corn and soybeans at 16. After West Point in the Army, I raced back to Chicago to go to university, but I'd always pictured myself on the floor of the Chicago exchanges. I ended up trading on all three floors of Chicago: the Mercantile Exchange, the Board of Trade, and the Mid-America Exchange is where I started, which was, you know, trading small contracts against Board of Trade contracts. When I got to Chicago, it was the very beginning of a concept called financial futures. It was new, it was untried, untested, and most people were pretty skeptical. But I thought it was a pretty good idea to trade futures contracts on the largest commodity of all, which is money. And so I dove into that feet first. I knew I was right when an old grain trader on the Board of Trade looked at me and said, "We don't need any stinking futures contracts on money." It turned out that would later be the star contracts of both the Board of Trade and the Mercantile Exchange. That included a stint on Wall Street. Financial futures were slow to take off. So I had some time to go to Wall Street and learn the cash market. So I traded government bonds for E.F. Hutton, God rest their soul. And it was an incredible time in the bond market. I mean, long treasuries were trading at 13.9%. Bond volatility was immensely high. That was clear evidence that we needed a hedging mechanism for interest rate risk. So it turned out to be very successful. From the floor of the Chicago Board of Trade, I became very bullish on bonds when they were trading in the high teens. And so that was one of the best trades that I've made. I had called all my institutional customers that I was handling and said that we at AG Becker will no longer be accepting sell tickets on Treasury bond futures. My customers would kind of chuckle and laugh. An hour later, they would call up to say, sell 1,000 SEP, and I'd hang up on them because I had explained all my context that Treasury bonds were like holding a beach ball underwater. Later that day, I get a call from my boss in New York, John Eckstein, who is an important force on Wall Street. And he said, Brad, I understand we're hanging up on customers when they want to sell. I go, yes, sir. And this is the reason. And I ticked off all the reasons why bonds were going to go up for decades. And at the end of the conversation, he said, Brad, carry on. So I didn't get fired.
So let me just pick up on a theme that you mentioned there about money as a commodity, right? Most people, when they think of commodities, they think of course, pork bellies, orange juice futures, et cetera, right? But why did you see that money was a commodity when everybody else didn't see that so clearly?
Well, that was pretty simple. All the other commodities were priced in that money.
Right. And so the very thing that they were priced in itself was a commodity that influenced them all.
Exactly. So with the financial futures under my belt, I started investing in another new asset class called hedge funds, starting in 1982. The name had been coined by Mr. Jones years before, but nobody was really using the term.
Mr. Jones being Paul Tudor Jones?
No, no, it wasn't Paul, who I know. It was, I'll think of it in a second.
Okay.
He ran the first long short hedge fund at the time. They were really called investment partnerships at the time. But I thought it would be a good method of diversification to take money out of my financial futures account and hand it to other risk takers that had different styles, different focus, different techniques from the market in different asset classes. So it was easier for me to evaluate risk takers than most, perhaps, because I had been a trader. By that time, I had traded on Wall Street, LaSalle Street, and Montgomery Street in San Francisco. So I knew quite a lot of risk takers. And so that turned out to be a pretty good portfolio decision, because I was able to find guys like Richard Dennis and Tom Shanks and Liz Cheval. I was actually Ray Dalio's first customer when he opened up Bridgewater, the very beginning.
Wow. And so I think it was mentioned in an article I was reading about you online, that about the early days, in Chicago, in the pits, and how traders would support each other. And you even funded a guy $50,000 to get back on the floor after he had gone bust, but you made him go running with you at 6 a.m. each day.
On Lakeshore Drive. Yeah.
On Lakeshore Drive.
He paid back pretty quickly.
So what in your estimation does make a good risk taker? What have you seen over the years?
Well, that's multidimensional question, but it kind of depends on the style and time frame. Most of my competitors in the Treasury bond pit were policemen and firemen, and my competitors thought the Federal Reserve was an Indian reservation in Wyoming.
They hadn't gone to University of Chicago and gotten their master's degree in MBA, right?
But they were street fighters, and they were very, very, very good at what they did at their time frame. But it was basically 2-bit at 3, and if they got lifted, it would be 3-bit at 4. So they were just constantly trying to grab the spreads, and that was a very good technique. I've always looked at the markets on a longer term view, maybe too longer term, but I'm not really interested in the day-to-day 5-minute charts and things like that. I'm looking. Right. I think trends are easier to discern in a longer purview.
Such as, bonds being a beach ball underwater 30 years ago.
Bonds had a 40-year bull market, so
right.
One can expect we could see a similar kind of time frame on the bear market. We'll see.
So I take it you're not, you don't think bonds are a beach ball underwater today?
I would rather be waterboarded than own 30-year treasury bonds.
Wow. All right. So moving forward, you've helped start Financial Futures.
So I I started investing in hedge funds in '82, and am credited with inventing the model of seeding emerging hedge fund managers with venture capital, which I started in 1985. So I've done a lot of that over the years. Moved to San Francisco to be closer to technology, continued to invest in hedge funds and alternative assets. My specialty has been new asset classes my entire life. And one of those new asset classes that I'm particularly proud of is I did the first life settlement transaction ever done, which was the purchase of a life insurance policy. And so the timing of that turned out to be pretty interesting, because the ability to liquefy an asset that had never had liquidity before became quite important. So started a company, took it public on the NASDAQ. We actually won the Investor Dealers Digest Private Deal of the Year award because we securitized a basket of life insurance policies of people that had terminally ill of AIDS, and sold it on Wall Street as a bond, which was really a cool transaction because everybody won.
Those people needed cash from their policies, and you were able to get it for them and make some money off it to boot.
I guess because of my bond background, I finally figured out that a life insurance policy on an elderly person or someone that was terminally ill is really a variable maturity zero coupon. If you can estimate the maturity, you can price a zero coupon. That was basically the theory.
It seems like this is a theme, of something that other people weren't seeing that you then saw that seemed obvious, and that becomes a new asset class.
Yep. Well, I guess it's by design, because I had figured out with Financial Futures and some of the early managers, the CTAs and so forth, that the inordinate returns were often in the beginning before a market matured. So I used to pay some of my earlier managers 6 and 30 on the monies that they were managing for me, which seemed like a lot at the time, but it really wasn't, because there was money laying on the pavement to be picked up in front of the rollers.
Today it's more. It's are people even still doing 2 and 20, as they say?
I'm out of every hedge fund now. I have some crypto hedge funds, but the reason I exited this space is that it, even at 2 and 20, it seemed to me that the set of available returns were not worth the fees being charged to gather them. And so as a result, those fees have continued to march down, and will continue to do so. It's actually one of the strongest trends I've ever observed. And the reason I say that is that the price of commissions and the price of management fees never upticked. They've just been gone straight down. In fact, a couple of weeks ago, I heard of a Texas institution offered a prominent hedge fund that has a very successful track record, a fee structure that I had never seen before. The institution offered the hedge fund manager 1 or 10 and gave him the choice of which he would prefer.
Wow. So if you look back to 1985, the beginning of the hedge fund industry, there was a lot of upside to the market. And now, 40 years later, something has been exhausted, right? And those fees are going down. Is it just more and more people entering the market, or has the opportunities that they were pursuing back in 1985 actually been exhausted? They're not there anymore.
I think it's a combination of both. The set of available returns is just not what it used to be, and there's been very little barriers to entry to the hedge fund world, so we've seen lots of hedge funds.
Right. Yep. All right. And okay, so crypto, is that the next asset class after your life settlement policies?
Ron had mentioned 8 years. It's actually been 11 since I've been involved in crypto. I learned about Bitcoin from a 14-year-old Bitcoin miner. I always listen to 14-year-olds. But the idea really resonated with me at the very beginning. Got heavily involved. Began joining the speaker circuit around the world, talking about Bitcoin and so forth. It was basically talking to the same audience at all times, but it seemed like a fundamental change to me. I had found the internet before most, which is kind of a funny story. I was walking down the Embarcadero 4 past the Hyatt Regency, and somebody had scotch taped a hand scrawled sign to the window of the Hyatt, and it said "Internet Conference, 2nd floor." And I said, I wonder what that is. So I walked up to the 2nd floor. There were 3 booths, 7 people, and I bought Rodder.com. I had kind of a similar reaction to Bitcoin and the miraculousness of the blockchain as I did when I saw the internet. And basically the fundamental vision that I had at the time was very simple. Does the internet deserve its own currency? Of course it does. Now it's still early days. It's been 13 years, I think, now, since Satoshi Nakamoto did the first block. I've gotten to know Satoshi through some of the work that I've been doing, and it really is an important development. It's up. Excuse me. I think it's one of the most fundamental inventions, certainly in our lifetime, but even preceding that. I said to Satoshi in a conversation with him, I said, I've always used the same phrase in every speech I've given about Bitcoin. And Craig Wright said, yeah, what's that? I go, I've always said that Satoshi Nakamoto, whoever she is, deserves the Nobel Prize. He kind of laughed and said, I've got a big ego, but I've never thought of it that way. Why do you think that? And I said, I think your Bitcoin and blockchain will have a greater impact on the whole of world society than did Christianity, which only impacted a portion. So it's up there with the printing press, the internet. It's really the first breakthrough potentially in the world of accounting in 600 years. Since double entry accounting, the Bitcoin and blockchain promises triple entry accounting, which presumably will have a long-term positive effect on fraud and things like that.
So I want to pick up on a few things there, but I want to go back first and just, you see money, you see that money is a commodity, and you help kickstart the financial futures industry. And then you see that the internet needs its own money, right? So what's wrong? Why can't, the US dollar be the currency of the internet?
Well, I think that's why you're seeing the rush of all the sovereign governments to do just that with the central bank digital currencies.
Mm-hmm.
The main distinction is that in these central bank digital currencies will be like the other fiat currencies. There will be no limit to the amount that they can be produced, and
Mm-hmm.
so that there'll be
you need a digital currency in order to to be compatible with digital technology, and not to have the latency that, say, bank-based or even MasterCard, Visa-based transactions have.
Yeah, I think that's true. I think there'll be widespread use of central bank digital currencies, which isn't vastly different than the way you view your balances now at Chase Bank. Mm-hmm. It's pretty much already digital. It's more cumbersome to pay someone in Lithuania with your Chase account. But the real promise of Bitcoin and select other currencies is that they have finite supply. This is the first commodity in the history of man that has a finite supply, which is probably the most interesting thing about Bitcoin.
Mm-hmm.
But
it does have finite supply, but on the other hand, somebody could make just another version of Bitcoin, right?
Well, that's why we're in a bear market.
Because that's what happened.
That's exactly what happened. And it was easy to observe. There are now 20,000 currencies. The analogy that I was using to warn people about the situation we're in is that by having just all of these currencies coming to market, it was like having 1,000 golf foursomes playing universal best ball. Mm. When someone hit a good ball down the fairway, that everybody would run to there and hit from there, i.e. steal what the inventions that they had developed, the breakthroughs, the new ideas. Mm-hmm. And so that's what's caused this enormous pace of development and innovation, which I've never seen before. When the internet started, it was San Francisco. There was a little bit going on in New York, but the internet was San Francisco. And I was just lucky enough to be there in the epicenter. The cryptocurrency is exactly the opposite. There's more going on in Estonia than there is Palo Alto. And it really is a global effort, if you will. And that has enormous ramifications, but there are issues.
Encouraged that 1,000 foursome best ball game has produced some significant innovations.
It's produced very significant innovation, but it's been a negative for the space. In other words, the human beings in the space have not been able to grapple with 20,000 currencies. Right. Many of them are ill-advised. Some of them are frauds. It's too much. Human beings just do not have the ability to assess or evaluate or trade or own that kind of number of currencies. So I've been a little bearish. I've been aggressively diversifying for a couple years, it it made me nervous that that on Twitter, crypto Twitter, you would see all these guys like Michael Saylor with laser eyes. That was a very bad sign to me.
Mm-hmm.
There is still disappointing uptake of Bitcoin and cryptocurrencies. Nobody's using it. And
Right.
the industry thinks it's because the UIs are not yet developed. There are immense cybersecurity implications to this. And so I've got a pretty good background in cybersecurity.
Yeah, I'd like to talk about that a little bit, but keep going.
But the Bitcoin happened so quickly that it leapt ahead of its skis with the ability to secure the network and secure the wallets.
Mm-hmm.
I like to say that the most valuable data in the world used to be in the Pentagon. That's no longer the case. Most of that data has already been pilfered and stolen and copied. The most valuable data in the world at this moment today, as we sit here, is a Bitcoin private key. And people are coming for them.
Yeah. So you said you've been talking to Satoshi and that you think Satoshi is Craig Wright.
Yeah.
Want to tell us a little bit about that?
Yeah, he's a controversial figure. I've said more people are neutral on Donald Trump than on Craig Wright.
That's true.
But he's I find him to be pleasant, a polymath, and an amazing individual. He is. He's doing just what you would expect Satoshi Nakamoto to have done when he built the project and walked away from it. He labored away in an obscurity and wrote another 1,200 patents on blockchain.
Mm-hmm.
So he's a real academician. I think he's got 15 degrees or something like that. So he's a real scientist and futurist.
And he has developed a different version of Bitcoin.
Well, he would say that he's developed Bitcoin.
He's developed Bitcoin, right?
It's being labeled by the asset class as a Bitcoin fork, if you will. It's called Bitcoin Satoshi Vision, BSV.
Right.
It trades at a fraction of what Bitcoin is trading for. But I mean, it's a pretty intriguing protocol, because as you think about these 20,000 competing protocols, the only shortage that's going to exist in this marketplace is for block size, is to be able to put data into an immutable blockchain that can never be changed. And so it's pretty easy to create block space, and many of those 20,000 currencies have attempted to copy the best aspects of Bitcoin, the best aspects of Ethereum, and then put it into a new wrapper. But there's really no shortage, if you will, of block space. It reminds me when in the early internet days, there was a similar market that had popped up that was trading derivatives and futures on something called IRUs. Do you remember that?
No, I missed that.
An IRU was the indefeasible right to use a strand of fiber. And everybody was stringing fiber around the continents of the globe. They got a little too excited about the prospects of the internet, and they laid too much fiber. And the fiber became dark.
Mm-hmm.
And all the IRU contracts went to zero. But the main difference between that and block size, and the reason I bring it up, is that in order to lay fiber, you actually had to rent a boat and lay cable on the ocean floor. So there was a gigantic capex involved in doing that. It's not really the case in the cryptocurrency. the protocols are typically open source and can be copied in 30 minutes. So there's no shortage of block size, if you will.
Mm-hmm.
And that's why the market's getting splattered, in my view.
Mm-hmm.
The market also we've never experienced a monetary tightening before. So
A monetary tightening.
yeah.
Right. Yeah. There's been some half-hearted attempts with quantitative tightening, but this seems to be in earnest.
Yeah. I forgot to mention, Alan Greenspan was my first boss.
Really?
At the Council of Economic Advisors. I worked.
How did you like him?
He was just as gregarious as his reputation. He's very serious guy. He was a gold bug at the time, which I found interesting.
Right. That is a fascinating aspect of Greenspan, that he was a gold bug.
Yep.
And then he became the printing maestro.
Yep.
Good. So other cryptocurrencies that you're interested in today?
You know, I've been a Bitcoin centrist, but it was involved in early
Bitcoin,
days.
BTC.
BTC.
Yep.
I helped pioneer some interesting projects. I've seeded a project called MadeSafe, which was a Scottish distributed, decentralized, distributed database that had great prospects. I flew to Troon, Scotland to meet the team after another 14-year-old had told me about the project. So I invested in
to listen to 14-year-olds.
I always listen to 14-year-olds. I collect millennials. Some guys collect cars. And so that was really a precursor to Filecoin and Storage J. It was even before Ethereum. It turned out to be a great investment, but it took me literally 2 years to sell the position, and they're still not live today, which is pretty interesting. So I've made some selective bets in projects like Cosmos. I was the seed investor. Casper, which is an enterprise blockchain, I was the seed investor. But I've had a very fine filter because there's too many currencies, and most of them are duplicitous and unnecessary.
So in terms of, one of the things that makes me a little uncomfortable, in the blockchain space is that, there's so many different chains now, and then you have this idea of multi-chain, right? And, as an example, I was trying to play a pay-to-earn game, right? And I had to go through about 6 different, moves of changing one currency into another, play the game, and then to get it back out, another 3 steps, right? So it just seemed like huge security vulnerabilities, not to mention transaction costs, going through all that.
Was that Axie Infinity?
It was similar to that. It wasn't that, but it was very similar. Yep.
Yeah.
So, do you think that the future of blockchain is multi-chain, or do you think it's going to be one chain to rule them all?
No, I think there'll be numerous blockchains that have different purposes, but there ain't going to be 20,000. There are interesting, very fascinating projects going on, like Helium, for example. Have you heard of that? Helium is a distributed mesh node that all of the members that join that node have the ability to earn Helium tokens by presenting that node to the community to do IoT messaging. Pretty cool idea. And the new antennas that they're coming out with will actually be able to repeat 5G signals. So your neighbors will be able to use your node, make phone calls, and pay you helium tokens instead of the phone company. That's pretty interesting.
It's pretty interesting.
The major problem with cryptocurrency now is adoption. And everybody thinks that it has to do with the UI, the experience that you underwent, and the complexity of KYC and sending money to an address, which is a bunch of digits. And those are all key frictions, I think, in this thing. But the real reason why nobody's using this stuff is that if and again, I'm speaking from a U.S. taxpayer perspective. If you're a U.S. taxpayer and you're following the rules and you use some Bitcoin to buy a double decaf non-fat latte, you must pause then, or certainly pause by the end of the year, and figure out the goddamn capital gains on that latte. Nobody in their right mind is going to do that.
Right.
And that's why Bitcoin adoption has been disappointing to me.
That makes perfect sense. Another thing that's concerning to me in terms of, I see all these attempts to try to facilitate adoption, right? But all that kind of, take Coinbase, for example, right? Or OpenSea, et cetera, NFTs. It just seems like all of these attempts to make it easier to use are actually end up being kind of antithetical to the underlying technology itself, right? You end up with these very centralized controllers, essentially, for what's supposed to be a decentralized future.
Yep.
And I don't think people realize that that's what's happening in these attempts to make it more, relatable or accessible to people. But I do think the point you make about having to calculate your capital gains tax on buying a latte is that's a tough one to overcome. And it definitely stops me from spending Bitcoin.
Yep.
Yep.
There's some interesting trends that should be wind at the back for all cryptocurrencies, including central bank digital currencies. I think Elon's Starlink is one of the most significant potential impacts for Bitcoin, which means that a Uganda farmer can basically price his rice and trade it for Bitcoin without leaving the farm.
So what are there, you mentioned helium. Are there other projects that you think are long-term opportunities?
Yeah, again, I have a very fine filter, so I don't like most of this stuff. I've been bearish. I probably own the least amount of Bitcoin that I have since 2013. There are 137,000 Bitcoin about to hit the market from the Mt. Gox distribution. That was a big currency hack. That was the biggest hack that had happened in Bitcoin at the time. And I don't believe that that's been properly discounted by the market. And the reason I say that is I talked today with a female friend of mine who got nabbed in the Mt. Gox heist, and she was not aware that those coins were going to be liquidated and distributed. So I don't think that's been priced into the market.
So we do have some questions here. I'm looking over to this other board here where some of the questions are coming in. So I'll just bring a few questions from the audience in. One is, what are today's 14-year-olds likely interested in?
Well, the times are changing. I have a 26-year-old son. I started paying him his allowance 10 years ago in Bitcoin.
Lucky him.
Son of a bitch is rich now. Left the country. But he was he's now living in Stockholm. He was back to visit me when I was still in San Francisco before COVID.
Mhm.
And he went in to see his buddies, and he came back that night. I said, "How are the boys?" He goes, "It's weird, Dad." I go, "What are you talking about?" He goes, "None of them have jobs. They're all living at home in their father's basement.
Hmm.
They sit home every night and play games and smoke a joint, and they've given up chasing women. They know if they go into San Francisco and look for girls, it's going to cost at least $120, and they're going to come home frustrated. So they've made the decision. They're guaranteed a good time if they stay home with their buddies, get stoned, and play video games,"
Wow.
which was
That
which
doesn't bode well for our economy.
which was different than when we grew up.
Definitely. All
So-
right. Despite the cycles, it does seem that the Fed removing the commodity of money from the world financial system, that is quantitative tightening, is the primary determinative for all the worldwide bear markets, including Bitcoin and other cryptos. Would you agree?
I do agree, and it's a pretty unusual period. I was talking to a trend following pal of mine in Chicago named Anthony Strassman, and he runs a trend following indicator, and he called me and he said, "For the first time in my career, everything in my model is short. There wasn't one long out of, say, 40 positions." I thought that was very significant. I had not seen that before.
Wow. That's sobering.
It is.
What do you think about Russia creating a blockchain SWIFT alternative?
It's exactly what I would do if I were them. And so we're really living in a Tom Clancy novel at the moment with modern weapons. I think one of the most significant.
Picking up on that theme about homeland security, cybersecurity, et cetera, let's cover a little bit of that too.
Yeah, I had figured out very early on that the war in cybersecurity was a war I wanted to fight, and it was unlike the previous wars that I studied at West Point and since then. But the war in cyber was unique in three different ways. Again, according to my analysis, the war in cyber is the first war in history that can't be won. There's no flag, there's no capital, there's no general command staff to surrender.
Wow.
It's the first war that can't be won. It's also the first war.
I don't know what that even means.
It just means
endless war.
It's endless cyber war, as long as we're using computers.
Yeah.
It's also the first war in history that we're facing thousands of adversaries, nation states, criminal gangs, terrorist organizations, pimply ass teenagers in their dorm room. We're facing thousands of armies at the same time. And last but surely not least, it's the first war in history that we're all on the battlefield for. The wars used to be over there somewhere. So this is my kind of war, and I not only is it important to fight, but I think everything else rests upon it.
And I've heard you call the time we're living in World Financial War I.
Well, yeah, I was going to mention that earlier. That of all the macro things going on right now, I think the United States capturing Russia's sovereign FX reserves will go down in history, perhaps with Nixon closing the gold window.
Mm-hmm.
You can't really take someone's sovereign reserves. They're sovereign. And I believe that move by the United States is causing sovereigns all around the world to rethink the perceived safety that they had before that move in owning US stocks, bonds, its currency. I'm not sure the United States deserves to be the reserve currency. And if that slips and begins to slide, the only event that I could think of that could happen to the planet that would be worse than the loss of the dollar as a reserve currency may be a multiple meteor strike. It's going to affect everything. And
well, somebody's buying the dollar today.
It's
going up and up. Although
yeah,
I think the ruble's going up more than the dollar.
absolutely. But I mean, it's very strong now, and there's lots of dollars that are panicking out of Russia, Eastern Europe, as Europe itself. So it's the cleanest shirt in the laundry, but the dollar has been going down my entire lifetime.
Mm-hmm.
It's lost 95% of its value in my lifetime, and I'm still young.
Right.
Mountain Dews used to be a nickel in Iowa in the vending machines. Now they're $2. That's approximately 95%.
That is. So looking at all this, we've got this revolutionary technology, blockchain, although, and you've said banks will become as common as Blockbuster videos.
It's interesting. Bank equities are acting miserably here, even in a face of an increasing rate environment where they should have had a bid.
I'm just, you see such a big picture. I'm wondering, what does this picture mean? All this stuff going on. You have blockchain coming online, disintermediating the banking system. You have cyber warfare, endless. You have World Financial War I. What does this mean for, the average person watching this interview?
Well, the average person watching this interview, the average human in history doesn't really get to experience the peak of a great civilization, although it happens over and over and over. I've been giving speeches for years called "Investing at the Peak of U.S. Civilization." I think we're there. I think this is what it looks like. If we were experiencing the peak of a great civilization, it would look a lot like this. And so
it's not about to all get better. It's going to be all downhill from here. Well,
I mean, that's perhaps where cycles can come into play and be our guide. It sounds bold to call it peak of civilization, but it's really not. There have been thousands of civilizations come and go. Every single one of them has peaked, and it's very difficult to see the peak, to contemplate the peak of a civilization when you're in the middle of it, because the ramifications are so extreme, your brain doesn't even let you go there.
Yeah.
But they all peak. And one of the greatest geopolitical events that's happened in the last few months was the China-Russia no limit alliance. Did you see the details of that?
No.
So I think it's significant. It's now 2 against 1. It may be 5 against 1 if you add Iran and North Korea and our other adversaries. So,
and it's interesting to see the world leaders that aren't opposing, the Russian aggression, right? So you have India, Brazil, a lot of the BRIC countries.
Exactly. And we're seeing what's really interesting, I think, from my perch is we're seeing lots of very complex systems begin to collapse in unison. The food production, energy delivery, refining of energy, air travel has collapsed in Europe. Have you been watching that?
I mean, I see bits about it in the news, but I've been staying home for a couple of years.
Yeah.
So it sounds like my biggest takeaway is that we need to let our minds be open up to a new world, really. We can't assume that the future is going to be anything like the past right now.
Right. Right, I agree. And one of those complex systems is our supply chain. So I think one of the most important macro events ahead of us in the next 10 years is going to be the re-onshoring of our supply chain, which is going to cost a lot of money and be inflationary. But from a national security perspective, we have to be able to make neon gas in the United States. How come we're not doing that? Mm-hmm. Neon gas is produced in the Ukraine, and it's absolutely required to process the manufacturing of microprocessors. We have no neon supply.
Do you see investment opportunities in the onshoring of supply chains? That seems to be a major theme for, if we're talking about the next couple of decades. What's your favorite trend for the next 2 decades?
Well, there'll be a couple of competing aspects of the onshoring. The biggest thing that I'm worried about is the collapse in fertility, not just in the United States, but around the world. And a lot of that has to do with the economic value of children. And I learned this at an early age, and I often refer to the Krogmeyer example. Have you heard of the Krogmeyer example?
I have heard it from you, but why don't you tell the rest of the audience?
So the Krogmeyers were our next door neighbors at the farm next to us in Iowa, and they had 9 children. When the school bus would stop to let them off, we'd be there for like 8 minutes as they were piling off the bus. And as the bus pulled away, you could see the Krogmeyer children fan out across the farm. Some would go to the kitchens to begin the meal. Some would go to the dairy barns to milk the cows. Some would go to the hay fields to bring in the hay. They were 9 economic assets.
Yeah.
I have a 26-year-old son, and he is not an economic asset.
Nor was he when he was 14 either, huh?
So the value of children, there's no other way to say it. The value of children has gone down.
Yeah.
It's too expensive. And so
that's a problem.
Can that problem be solved? I mean, that's a pretty big problem. I think one of the near ways to solve that problem with onshoring is going to be robotics and 3D printing.
Mm-hmm. Yep.
3D printing hasn't really happened yet, but my friends at Singularity University think that 3D printing will be so important as it will impact ocean freight. More things will be made locally. Clearly, robotics are going to be a big deal. Mm-hmm. I like to say there's only going to be 2 kinds of people: those who design robots and those who work for robots.
I'm not sure I like the idea of that future. All right, Brad, anything else that you want to share with our viewers?
Oh, well, I think just to accentuate the last part, there's a gigantic, if you believe in cycles, as we all do, mm-hmm. One of the most important cycles that we're going to be dealing with now is the cycle of the global pendulum that swings from globalism back to populism. And that's going to be a worldwide phenomena. That pendulum, I believe, is gaining momentum. They will tend to overshoot, if you will, but I think that's probably going to be a tradable play in the longer run.
More populism.
Yeah.
Yep. Fantastic. Well, Brad, we really appreciate all the time you've given us. We appreciate your support for the Foundation for the Study of Cycles. And it's been great talking with you. We've gotten tons of questions, so we'll probably follow up with some, and maybe we can share them via email with the audience and later on.
Happy to do so.
Thank you so much.
All right.
Bye.
Fantastic insights. I'm sure many of you would have picked up some golden nuggets that I could see on the chat. Plenty more questions, which we hope to get back to, and a lot of positive feedback. Thank you so much, Richard, for hosting that interview, and for Bradley Rotter for sharing. Okay, now on to our next speaker. FEC board member Jake Bernstein, who will be speaking about interest rates, currency, long-term cycles, and truly much more. You already heard him share a few highlights yesterday. I recall Japanese yen and palladium and other key nuggets that he'll be mentioning. As a brief intro, before he kicks off, Jake Bernstein has been publishing Jake Bernstein Weekly Futures Trading Letter since 1972 and trading futures and stocks since 1968. His forecasts and opinions are quoted regularly in the financial press and on financial websites, including Wall Street Week, CNBC, JAG FN TV, and WebTV.com. Bernstein is a consultant for investors, traders, industry, financial institutions, brokerage firms, and commercial firms. Traders, money managers, and hedgers, both new and experienced, subscribe to his market advisory service. Jake, welcome. Wonderful to share your insights. Second time around for the year. So much has changed year to date. Please share your slide deck and lead the way.
Thank you very much. I appreciate the opportunity to present for the foundation. Very important part of my trading career has been the foundation, because that's how I originally found cycles, and that's the basis of my work. So without further ado, I'll begin now. We're talking today specifically about long-term cycles and interest rates, currencies, and small trader sentiment. And first, a little bit of an introduction, the usual disclaimer. So you should now be seeing slide number 2. Any moment now, here you go. And so you've probably seen this at least 100 times, so it hasn't changed since then, it's the same. You can lose money trading, and what I'm presenting here today is strictly for educational purposes and evaluation of what I'm doing in the way of the markets. I want to thank the Mount Foundation for the outstanding support, especially the FSC staff, members, and the board, and kudos on a great round of presentations here. So today I am in a place called Bonnie Doon, California, which is on the California coast. I'm deep inside the redwood forest, right over here, about 1,500 feet above the Pacific Ocean. Nice and quiet, good place to be generally off the grid, and we enjoy it very much. So today, just generally speaking, a little bit of an introduction of who I am. I've been a trader since 1967. I've authored over 43 books on trading by major publishers. I'm a real trader, which means specifically I really trade, and I do so practically every day. I am not primarily a day trader, although I am a short-term trader. Everything I do is purely technical, no fundamentals whatsoever. My work is computer-based, it's tested, and is developed in all of my strategies. And so in my work and the markets, I've taught thousands of traders all over the world. I've done about 883 seminars, webinars, and so forth. I'm a member of the Foundation for the Study of Cycles. I've been on Wall Street Week, CNN, FNN, CNBC, and so forth. And the good news is I'm not a broker, I'm simply a trader. So everything I do is 100% objective, completely rule-based, and I don't do any analysis. My clients, individual traders, top newsletter writers, and some of the biggest hedge funds in the world subscribe to my research. So let me give you an idea of what I do and hope that it can help you in your trading and investing. So I started trading in the summer of 1967, which is when I discovered cycles in the old Cycles magazine that was published many years ago. I was fascinated by what I saw and felt that I had finally reached the point in my career where I could depend on things in the market to be clear and consistent. I studied cycles intensively for a number of years before I started trading, and then began developing my own indicators. So what you're going to see here today is a very small portion of what I do, specifically based on repetitive patterns and cycles. The most important thing I can tell you about my work is this: everything I do is based on patterns. Patterns pervade everything we do, whether it's the cycle of life, birth, maturity, maturation, old age, and death, the cycles of the planets, the cycles of the weather, the cycles of patterns in the markets are all related. And in my view, if we find the right patterns and develop them properly, we have a lead on the market and what we can do. So my use of cycles is purely pragmatic, certainly interesting from the standpoint of science and philosophy, but I don't get involved in that too much. I'll leave that to other people. My applications are strictly for the purpose of investing and trading, making money, and then, of course, the development of patterns that will help humankind in general. So we're going to look at some examples of patterns and the trading model that I use. So the first thing that I do is use a trading model, which is very specific. It consists of 4 parts: setup, trigger, follow through, and profit maximizing strategy. In other words, it's a specific approach to using patterns. But in order to use patterns, we have to find them first. And the fact of the matter is that using computers, we can find literally hundreds and thousands of patterns. That's the good news. The bad news is, excuse me, the bad news is that most patterns don't work. They don't test profitably. So if we ask the question, does this particular pattern go forward in real time and produce predictable results? The answer we find in most cases is no. Example, a very popular pattern among traders is what's called the key reversal, which I'm showing on the screen right now. It consists of a 2-day pattern. Day number 1, day number 2. On day number 2, the algorithm is very simple. We trade below the low of day number 1, and we trade above the high of day number 1, and we close above the close of day number 1. So it's also called an outside reversal. In other words, we supposedly clean out the stops below the market, clean out the stops above the market, and then we're ready to go higher by closing higher on the day. This very popular pattern looks good on paper, looks good on the computer. There are literally thousands of them. That's the good news. The bad news is that in testing, we find that this pattern predicts nothing. It is very low probability of success in predicting future events. However, making a small change by adding one item to the algorithm, which is a higher close, the third bar, the third day, makes the pattern predictable. This pattern will go forward and predict 5, 10, 15 days out what's going to happen to the markets. So this is an example of a pattern in terms of what it does. Setup over here, trigger over here, and then of course comes the follow through. The follow through consisting of 2 parts, and that is the profit maximizing strategy and the stop loss. So in this case, the setup is here, the trigger is a timing indicator, and the follow through is a profit target and a profit maximizing strategy. Within the context of what I do, cycles are a pattern. They fall into this group right over here. So it's not sufficient for me to have a cycle or to know what that cycle is going to do and where it's going to go. But what's important to me is, will the pattern lend itself to being timed? In other words, when will the pattern bottom or top? And then will the pattern allow us to take a profit at some point? So if I say there's a 5.7-year cycle, low to low in corn, that's wonderful. But what do I do 5.7 years from the last low? Today, I hope to show you some of the tools that I use in order to zero in and zoom in on that second trigger. So in the process of giving you my methodology and telling you what I think is going to happen based on the cycles, I'm also giving you an indication of how to do this on your own. So let's go forward to the next slide for a moment. And by the way, if you find that you're still lacking information or something is unclear, you're always welcome to write me. I'll give my email address at the end. So let's go to the next slide and give you an example of what I'm talking about. So my primary indicators are price cycles, cycles and indicators, divergence, seasonality, which is the cycle that occurs within the course of a year, the commitment of traders report, and the indicator patterns. So these are my primary tools. Today, I will show price cycles, seasonals, and the commitment of traders report, how they work together in giving us important moves and predicting important moves. So let me show you specifically what I mean. I'm going to switch now to a chart of euro-dollar interest rate futures. Not to be confused with European currency. The euro-dollar is a short-term interest rate market. It measures European currency, it measures the American dollar in Europe. So it measures short-term interest rates in the 91 T-bill, similar to the 91 T-bill, but traded in European banks. So this is really an interest rate future. You can see from the chart it's been a fairly symmetrical cycle, not perfect, not a beautiful sine wave, but still, interestingly enough, approximately 1, 2, 3, 4, 5, or 6 years between lows to lows. Right now, the cycle is predicting a low approximately 6 months from now, sometime later this year. In addition to this chart, I've shown several things on the chart. The commitment of traders in green over here, and small traders sentiment at the bottom of the chart. The commitment of traders report is issued by the US government every week, and it shows the 3 major categories of traders: large traders, small traders, and commercials. I'm not interested in what large traders or small traders are doing. I'm interested in commercials. Commercials consist of the largest traders in the world, specifically banks, insurance companies, government funds, retirement funds, and so forth. And so what I want to know is, what is their position in the market? When their position shows green, it shows that they are net long the market. In other words, they hold more long contracts than short contracts. And you can see how they tend to build up their long positions at cyclical lows, as they did over here, and here, and here, and here, and here. They're not always right, but the vast majority of the time they are right. So in building up a net long position as they are right now, they're preparing for a cyclical low in interest rates to come in the middle or latter part of 2022. So it is, even though this is not a perfect cycle, it gives you an idea of how we find the big moves. In addition to that, looking at the bottom of the screen by the red arrow, we see small trader sentiment. In other words, the small trader who is most apt to lose their money trading is shown here by what was called the Daily Sentiment Index. The Daily Sentiment Index is compiled in my office and has been so for since 1987 daily, and shows the consensus of opinion of small traders, in other words, inexperienced traders. And we find an interesting correlation. When the small trader is extremely negative, as they were here, and the large trader is buying at the cyclical low, that shows the most important, most predictable combination. So what do we have now? We have interest rates following their path to make lows later this year. We have small trader very negative, and we have the large trader buying. So this poses the perfect combination for a big bull market. Remember that interest rate futures are plotted the opposite way, namely, when futures are coming down, interest rates are going up. When futures are going up, interest rates are going down. So we can see that the current decline in interest rate futures is consistent with the current increase in interest rates in the United States and other parts of the world. A very important forecast, which is due to bottom in interest rates later this year, which many people are not expecting, because as you may know, they're talking about interest rate hikes to slow down a supposedly overheated economy. So we're going to go to another one momentarily and take a look at it. And remember, Not all cycles are this beautiful or symmetrical, but this is certainly one of the best. And it makes me wonder why the government has to hire so many people to predict interest rates when it's so easily predictable with the cycles. Let's go to the next chart. Here we go. Consistent with the interest rate cycle in short-term rates, here is a cycle in long-term rates, the 30-year bond. As you can see from the cycle, it's not perfectly symmetrical, nor does it predict all the lows or all the highs, but you see, generally speaking, it's been very accurate and has been almost perfect for the last 3 cyclical repetitions. You can find many of these cycles using the cycles application at the Foundation website. So what's the prediction? The prediction is lower futures, generally higher interest rates until late 2022, at which point we expect a bottom. So within the context of my setup, trigger, and follow-through approach, this is a setup. A setup requires a trigger, which is what most people call a timing indicator. You will notice from the bottom of the screen that the small trader is negative, not extremely negative, which is what we would require for a bottom, but certainly on the negative side. At the same time, the large trader commercial has started to accumulate long positions in anticipation of a low later this year. Remember that the large trader is usually ahead of the game. They begin their buying program before the market's bottom, and once the market's bottom, they stop their buying and begin to sell. So that is the 30-year bond cycle, still moving lower, predicted the top very accurately, and suggesting higher interest rates for the rest of the year, but not necessarily extremely high, given the fact that the small trader is becoming very negative and beginning to buy the fact that we're getting higher interest rates. To be perfectly clear, the cycle continues to point lower with the bottom due late this year. Moving to the 10-year Treasury note, a very predictable cycle as well. And this is a point of extreme interest to me. You will notice the ideal cyclical low on this shorter term rates is due right now. You can see a very big spike in commercial buying activity, also negative small trader sentiment. How do we put this together? It simply says short-term rates, the 10-year, will likely bottom before the 30-year does, which means there's an opportunity on the so-called yield curve, by which I mean long-term rates versus short-term rates. Again, you'll notice this cycle has been very regular, very predictable, not perfect, but certainly workable in terms of the trading standpoint, which is what my interest is. Note also, at this extreme high in interest rate futures was also an extreme high in small trader sentiment. So the small trader sentiment itself is a very good indicator and a very good pattern of lows and highs, which I will demonstrate clearly shortly. Let's go to the next slide. The next slide shows Swiss franc futures. And again, a very predictable cycle, not perfect, as you can see from the lows and the highs, and certainly past its low point. So this is an interesting cycle. What it says is the Swiss franc relative to the US dollar should have bottomed a few months ago. At this point in time, you can see strong commercial buying activity, which suggests to me that the Swiss franc has bottomed, or most likely bottomed relative to the US dollar, and may be one of the best currencies to own in the next few months. In other words, that the Swiss would appreciate against the US dollar. We shall see how that turns out. Similarly, the US dollar index would show an opposite sign, opposite signal. In other words, here's the short-term, the intermediate term cycle in the US dollar interest rate, in the US dollar futures, showing the dollar gaining and having scored a perfect low on the cycle right over here, over here, and over here for the last 3 or 4 cycles. So the cycle points higher, therefore no surprise that the dollar is moving higher against most currencies. And you can see the small period of commercial buying activity ahead of the bottom, which is made over here. So the US dollar, in terms of its cycle, is past the midpoint, suggesting we will top. Notice also the small trader is extremely bullish, the most bullish they've been since here. And you'll notice how the correlation looks. Bullish sentiments for the small trader right at the top, bearish sentiment at the bottom, bullish sentiment at the top, and now extremely bullish sentiment. In other words, meaning that the small investor believes the dollar is going to gain in strength against most foreign currencies. Usually the opposite will happen. Let's go to the next slide. And here's the slide for the European currency. Interestingly enough, the cycle is due to bottom right over here, and we are at the bottom of the cycle right now. You also notice at the same time, the small trader is very negative. So these two pieces of information are extremely important in predicting a low of significance. What's most interesting is this. Many traders are now beginning to believe that the dollar will continue strong, but the charts say no. The charts say that the dollar will top and that foreign currencies will bottom against the dollar. The one thing that's missing from this chart very clearly is commercial buying activity. We want to see the commercial come into the market on the long side. That has not happened yet. So the pieces of the puzzle are not in place, but we're waiting and we're looking at the charts daily to see how it turns out. But I would say it's a little bit late in the game to be short the European currency against the US dollar. There is considerable talk now that the dollar and the Swiss and the European currency are going to parity, namely that they will be equal. I don't believe that based on the charts. We shall see how that turns out. But remember, we're still waiting for the timing trigger. We have the setup over here. We have this setup over here, but we're still waiting for a trigger. That has not happened yet. Let's go on to the next chart. And sorry about the voice. It's allergy season here in California. I wish I could do better than that. Notice this. I've taken the same chart, the European currency chart, and added to it the cycle, but this time not in terms of price, but the cycle in terms of small trader sentiment. While it is not a perfect cycle, it does predict that the small trader should be at its most negative point right now, and that certainly has been the case. So these two go together very succinctly and tend to be very valuable in terms of predicting the direction of the markets. Let's go to the next slide now. And this slide shows, let me see what it shows. It's hidden. One moment, please. British pound. One of the most predictable cycles in all of the commodity and currency markets is the British pound. This bigger cycle in orange is 8.1 years from low to low, and the validity of this cycle dates back to the 1950s. It's been highly predictable, and within that 8.1 year cycle is a half cycle drawn in bluish green. What's happening right now? The British pound is on a declining cycle against the US dollar and is unlikely to move significantly higher for several more years, so the prediction is still bearish. Bearish the US dollar against the US dollar, which means you want to be long US dollar, short British pound. But you may do well to study this cycle. It's definitely beautiful. And one wonders why. Why it's so clear and why so predictable? 8.1 years. The next cycle is, let me go to the next page for a moment, please. Canadian dollar. You'll notice that the Canadian dollar cycle has been fairly predictable, not perfect, and is now due for a cyclical low late this year. I'm sorry, early this year or later this year. So I would be looking at the Canadian dollar as a bottom. You will also notice that at the top of the dollar, the small trader was extremely bullish right over here and is now becoming very negative on the dollar with a small amount of commercial buying activity, meaning that banks and financial institutions are beginning to buy the Canadian dollar against the US dollar. And commercials are net long this market, a very important feature that you will see repeatedly at cyclical lows. In other words, commercial buying, small traders selling, commercial buying, small traders selling, commercial buying, small traders selling over here. Let's go to the next chart. Moment, please. Here we go. Long-term cycle. And this is a long-term cycle in, one moment, please. The Japanese yen. This is one of my favorite cycles. I want you to see the beauty of this cycle. Not only is this 7-year cycle almost perfect in terms of predictability and in terms of regularity, in other words, symmetrically, but it also shows the great predictable relationship between small trader sentiment, tops and bottoms. As an example, the most recent cyclical low right over here, accompanied by massive bank buying, accompanied by huge small trader sentiment on the negative side. The lowest sentiment in the history of the Japanese yen was followed by a substantial move up against the dollar. Now on the chart, this may look small, but in terms of dollars, it's huge, because remember, the leverage in futures is about 98%. What's happening now? According to the chart, by the end of the year, and certainly now, the small trader is very negative. The major cyclical low is due, and the small trader is negative, with the large investor, the large speculator, buying large amounts of currency. So in terms of predictability, we're looking for the yen to bottom by late this year. Remember that even though cycles are very good looking in terms of reliability, they are not perfect, which means to me, the yen could bottom against the US dollar at any time now. Therefore, to pursue the short side would be, I believe, too foolhardy and too risky. It's in a beautiful cycle, and we can measure it. Let me show you. 1, 2, 3, 4, 5, 6, 7, 7.1 years on average, approximately 8 years. Go back and study this one. It's certainly worthwhile studying. Let's go on to the next one. Moment, please. Here we go. In addition to cycles and price, we look at seasonality. So the highest odd cycles occur within 6 significant periods of time during the year. And my goal is to know the complete cycle before it happens and take advantage of that. In order to do that, I do a search for seasonals. Example, if I search the database and ask the question, have there been any patterns in the Dow Jones since 1920 that have been highly predictable? Here is what I find. One moment, please. Here's what I find. I find that buying the Dow Jones or equivalent on the close of trading, October 26th, exiting close of trading January 12th, with a risk of 100%. Let's go to 15% risk over here. So it'll be October 26th to January 10th with 15% risk, has been correct 83% of the time. It's difficult to believe that since 1920, considering World War II, the Korean War, Desert Storm, the Gulf War, inflation, disinflation, the Great Depression, Democrats, Republicans, you name it, we have still seen huge consistency with 83% probability of being correct. In other words, what the chart says or what the table says is very simple. It says that 83% of the time, the closing price of the Dow Jones on January the 10th has been higher than it was on October the 26th, 83% of the time, without having gone against you by 15% or more. It's truly an amazing statistic because it tells us that there is regularity in the market and certainly cycles within the year, which we call seasonals. Let's go to the next slide. I can take the data and draw a graph. So if I take all of these stock index futures March contracts from 1987 to 2022 and draw one curve that has been detrended, this is what I get. The meaning of detrended is really simple. I've taken each year and made the low of the year equal to 0 and the high of the year equal to 100, giving me a pure and clean chart. Therefore, by knowing the percentage probabilities week by week, I can establish a trading pattern. I know, for example, that 80% of the time, The first week of December has been a bullish week. The second week of December has been a bullish week. In fact, there have been no predictably bearish weeks because most of them fall in the 50% range. This is the kind of information that I can use. I know, for example, that the month of February, the first 3 weeks have been very bullish, the arrows indicating statistically significant moves to the upside or conversely to the downside. Let me go to another chart and show it to you. In order to do my search, well, we can forget about that. I can search shorter periods of time as well. So for example, if I go to the location for searching and I ask the computer, show me trades in S&P futures for the month of April, which have been correct 75% of the time, that have had a duration of less than or equal to 25 days, this is what I get. So let's take a look at it. Here's the data output. One moment, please. Buying June S&P futures, close of trading April 14, exiting close of trading April 26 with a 3% stop has produced these results. Again, very important because most traders can't even achieve 50% regularity in terms of their predictable trades. But in terms of seasonality and cycles, these statistics are very high. And the best part is they can be tested so that we're not talking about opinions, we're talking about facts. This is a fact and not an opinion. And on the basis of facts, I can make money being pragmatic about cycles. Let's go to the next slide. If I wanted to look at all the data, every year, every statistic, every entry, every exit for this particular trade is shown in this table. I show that to you because in most cases, traders are not able to produce statistics to validate their claims. We can look at the performance like this. And again, I'm not suggesting to you a trade. I'm simply giving you an education and telling you if you would like to find trades that are highly effective, you will use seasonals and seasonal cycles, as well as long-term cycles, which will give you significantly bigger moves. If I take the S&P composite from 1984 to 2022 for the entire year, I can find the strongest periods of time. For example, October, November, December, very valuable information, not only for traders, but for investors as well. I can isolate specific weeks as well as the trend. This is the June trade, for example, right over here. This period of time, July, the first 2 weeks have been bullish weeks. This is how the trade turned out this week, this year, in June and July. In addition to that, we can use timing. So here is the timing indicator that I developed to take advantage of the cycles. Example, if we go back in time, you will remember I showed you the Japanese yen cycle. The Japanese yen cycle, as you will recall, points lower until the end of this year and has been persistently lower. By moving to a smaller time scale from a monthly pattern to a weekly pattern, we can develop timing triggers that take advantage of this move. So what the expectation was, namely that the yen would move lower against the dollar, has been borne out by the facts, and we've been able to take advantage of these facts by using timing triggers. So just in a few cases, let me show you a couple more. We showed the cycle in we didn't show the cycle in S&P, which has been bearish. We can take advantage of that cycle again by using shorter term timing indicators. I think I have a better one for you. Yes, the Treasury notes. You will recall I showed the Treasury note chart, the 10-year note indicating bearish activity at this time, at least until the middle of the year, bottoming right now. Taking advantage of that cycle by using shorter term timing. In other words, the indicator turns red indicating a sell, suggesting that the lower prices would be consistent with what we saw in the cycles. In addition to that, although I did not show the energy cycles pointed higher at this time of the year, and this is how we took advantage of those cycles with timing. And Bitcoin, of course, which we did not show cycles on, so I won't go into details on that. However, another market, copper. Copper has had one of the most predictable cycles in history, a long-term cycle, and the cycle bottomed right over here. And again, this combination, which I showed you before, cycle low, strong commercial buying, and small trader sentiment very negative. This is the ideal combination, the so-called perfect storm. It happened here. It happened here. Commercial buying activity, cyclical low, small trader negative. And over here, small trader negative, commercial buying activity, and cyclical low. Let's look at another one. Now here's one that's coming up, so pay attention, please. Although certainly not the most glamorous of markets to trade, cocoa has had a very predictable cycle. I'm showing the cycle on the chart. What is the combination we're looking for? Number one, we're looking for a projected cyclical low, which was due to occur late last year. At the same time, there was a small blip in commercial buying activity. And previous to that low, there was very negative small trader sentiment, which is becoming negative again. So even though the cycle has not bottomed on time, we remain in a time frame where the probability of a significant low in cocoa futures could occur at any time. So watch it closely. In a few months, we'll update this forecast and see how did we do. Notice what happened at the last cyclical low. Huge commercial buying activity, extremely negative small trader sentiment, perfect scenario at the cyclical low. And similarly here, small trader sentiment very low, commercial buying activity very high, and it'll do a cyclical low that was due. Let's go to another chart. Another indicator that we've developed is called contraction expansion. We notice that when a market is due to bottom, the cycle begins to narrow, volatility begins to decrease, and then once volatility increases, our indicator turns green, suggesting that a bottom has occurred. Let's go to the next one. Similar situation on the downside. As long as the indicator remains red, the market remains in negative territory. So in terms of the components, setup, trigger, and follow through, the cycle is a setup. This indicator is one of our triggers, and follow through consists of a profit target as well as a profit maximizing strategy. Let me show you a few more cycles. I think I gave you all the cycles. Yes, we looked at all the cycles. There are more cycles we can look at if we want to. Let me go back to full screen on this mode here. Just one moment, please. So in terms of the cycles, the important one is cocoa. Watch that closely. Another situation for which I don't have a chart right now is palladium. If you take the time to look at palladium, you will find very strong commercial buying. In fact, the strongest commercial buying in history. Very, very low small trader sentiment and a cyclical low. So palladium, even though it's a thinly traded market, has potential for significant movement to the upside based on the combination that I told you. So I'm basically done with my presentation. I hope you've learned something from it, and certainly I invite you to ask questions, and certainly invite you to ask me questions by email. My email address is jake@trade-futures.com. Let me put it on the screen. There we go. So I can be reached in any of the following email addresses if you have questions for me, and certainly Ron, if you have any questions, I'm happy to take them.
Thank you, Jake, for sharing the latest market insights with, as you mentioned, setup triggers and follow throughs for everyone to reference and consider. Our top question actually on your original framework, Jake, so the setup, trigger, and follow through in the context of dollar yen and that big bottom, that 7-year cycle, how do traders avoid catching a falling knife?
It's a lot better to buy on the way up than it is to buy on the way down. So in terms of the timing methods that I've developed, which include the moving average channel and divergence, one of the best ways to spot a bottom and not catch the falling knife is to buy on strength, which most traders can't do because they're psychologically not able to. But divergence is probably the best indicator we have And certainly if anyone wants information on that, they can send me an email. I will send them the 6 best timing triggers video, which explains how to use timing to avoid that falling knife catching syndrome.
Thanks very much. And then a follow-up question on gold, which you briefly featured. So big question in terms of what the hell's going on with the gold market, given that it's broken down lower, even though inflation is still strong, and there should have been so many reasons for it to hold up. There's a question from Steve. Jake, gold would seem to have extreme small investor sentiment and positive commercial activity. Do you agree? And what is your view on gold?
Beautiful question, Ron. The key to gold is this. We have been taught many years to believe that gold is a crisis investment, so that when there's international conflict, economic uncertainty, traders flock to gold. What's confusing most traders right now is the fact that it's not happening. The reason it's not happening is it's not time yet. If you look at the history of gold, the largest moves up have happened in August, September, and October. So the market is just waiting for an opportunity to bottom, and therefore it's best to stay aside at this point in time. And by the way, again, I apologize for the voice. I had a very bad case of COVID a few months ago, still recovering from it. So the bottom line is be patient with gold. I do not see any evidence of heavy commercial buying. I don't see sufficient evidence of small trader sentiment being too negative, but it's a question of time before the small trader throws in the towel, becomes very negative, and we are speeding toward that August, September seasonal low. Study the behavior of gold prices during August and September. You'll be quite impressed with what happens.
And as part of the framework you shared with us, Jake, so seasonality was a key part of it. And it was really interesting chart you showed there. I believe it was from late October to early Jan, an 83% probability of the market being up. Is there any context as to why that pattern exists, and just the fact that it's just such a great probability?
I wish I had the answer to that question. It never ceases to amaze me how cycles have been able to predict what's happening in the future, despite of fundamentals, in spite of government, in spite of currency fluctuations, in spite of the international situation. I can only say that it's been a valid investment cycle because of business. In other words, traders tend to invest money toward the end of the year and tend to throw in the towel and take their profits at the beginning of the year. I suppose that if I was a good researcher, I could go through and study what was it about every one of those years during the month of October that made stocks a valid investment. But I don't have that opinion. I don't have that capability, nor do I have the time on my hands to do that, but somebody should.
Anecdotally, of course, the October fall crash season, where typically markets have elevated volatility, so that maybe that shakeout creates the vacuum for a bounce back thereafter. It's interesting to see just how strong those stats are.
That's true. And interestingly enough, Ron, you also have dates into December, as you can see over here. So the computer gives us all of the possibilities and puts the best one at the top of the list. So this is the best one right over here, the first two. But there's also dates scattered throughout this period of time from October until January of the next year.
Okay, and Jake, could you just add some more color to the stop percentage area? I find that quite interesting. So we can actually kind of draw down thresholds.
Yes.
So, and 15% was what you're alluding to.
Yes, the 15% stop means that from the 26th of October until the 11th of January, stocks have been higher and have not closed against you by more than 15%. So that's where the 15% stop comes in. Very
useful information. A follow-up point is on, the COT commercial. Is just a breakdown of what exactly that is, especially for those who are looking at it for the first time. So Jason's asking about whether it's dealers, asset managers, or leveraged buyers, or is it a combo of all?
It's a combination of several entities, several enterprises, large traders, by which I mean commercial large traders, banks, insurance companies, hedge hedge funds, and corporations that need to hedge currency. So those would be commercials. In the grain markets, for example, a commercial would be a farmer, a commercial would be a grain elevator operator, a commercial would be a large end user. So these are primarily the individuals who need to hedge currencies or who need to buy, hedge, or sell hedge grains or metals.
And then flipping onto metals, there's a question from Mark about palladium, which seemed to be kind of a star trade setup. I know the chart wasn't on the screen here, but you did mention it. Question from Mark: what's the best way to play palladium beyond just buying futures?
There's PALL, the Palladium ETF. There's SPPP, which is the Palladium and Platinum ETF. Those are the two best ones that I'm aware of.
Okay, and then a follow-up on Bitcoin. It was mentioned, but I know it wasn't the key feature. Any insights you can share about Bitcoin?
The Bitcoin up until recently has been in a significant bear trend. Unfortunately, there are not sufficient longer-term cycles to make it a valid prediction, but the cycles tool, as shown by Lars very, very clearly at the foundation, has made some excellent predictions over the shorter term. And my work says that the Bitcoin will bottom at any point in the next several days to weeks. So we're looking for a low in Bitcoin.
Okay, and then a technical question on the volatility-based indicator. I think you described it as contraction expansion.
Yes.
How key is that in terms of your experience of using it for trade setups and any kind of additional information that you can share on that? Some of the delegates are keen to learn more about it, but also to know how to access it.
I've only recently developed this indicator, and I'm still learning how to use it. Initially, it's proving to be very effective. If anyone wants the code, I'm happy to share it with members, or anyone who wants the code, I'm happy to share it. I have the code available for Wealth Charts, Trade Navigator, Trade Station, and Thinkorswim, and I'm happy to provide it as part of what we do here.
Thank you, Jake. And just as a final wrap question, the audience heard you say previously the chart that made you the most money. Which one is that, and what was the story?
The story there was the chart of real estate activity of 17 and a third years, which I did not show here today, but I did show it in one of my annual forecasts that I made for the foundation. In fact, I think I showed it at the last annual forecast. It shows the 17 and a third year cycle in interest rate futures, in US real estate activity, which is topping between 2020 and 2022, which was the original forecast. The way it made me so much money was that I bought a lot of real estate at the bottom of the cycle, and that has done extremely well for me.
Thank you very much, Jake. Any final words you'd like to share with the audience and the foundation?
The foundation is a fantastic organization. It gave me my start. The research has been incredible. It has pervaded everything that I've done. So all the patterns that I use that are high probability are cycles and seasonals, and all of those thoughts and ideas came from the foundation. And I'm very much indebted to the foundation for this wonderful work they're doing. If someone is not a member, it's the cheapest thing that you can do with the best returns possible.
Thank you, Jake. Our FSC board member speaking about the value that we all want to bring to each of you around the world in terms of cycle application, general awareness, and ultimately actionable strategies.
Thank you.
Thank you, Jake.
Pleasure. Take care, everyone.
And just as a brief preview for day 3, yes, we are still rolling with this exciting agenda. Day 3, following on presentations from guest speaker Peter Eliadis on her cycle theories projecting future prices and current US market, and then FSC board member Bill Sarubi, US stocks, real estate, and the economy. Look forward to seeing you all tomorrow. Thank you from me, Ron William, FSC Development Director. If you would like to follow up with us, please check the website. See you tomorrow. All the best.
Take care, everyone.